Hi, it's Steve Hodgson at Modern Asset Management. Today is August 28th, 2019, and I don't have a PowerPoint show to walk folks through. We're gonna do a little exercise and take a look at a rental house that we've got in Pensacola, Florida. It'll bring us into a conversation about a seller finance note that didn't work out, which is, I think, something that's of value to folks that listen in. Seller finance and partials are two of the crazes right now, and this note had both of those things. So, what have I got on my screen? Um, I've got resume share. We should see, Nick, if you give me a thumbs up if you see a PDF for the property. Alrighty, good. Thank you, sir. This is, let me see if I can make this bigger. This is 24 Lincoln Road in Pensacola, Florida. This is the second property that I bought. We bought down there. We bought this the very end of 2016, boarded it. We did a start date of January 1, 2017. And this was just a general Bigger Pockets quick little pro forma that says what we thought we were going to do at the time. I like the Bigger Pockets stuff. I'm one of their pro members. I get access to things you normally have to pay for, but this is a quickie little tool that they have. And so we bought this house. It needed some rehab work, but it was already tenanted, and it was tenanted with a buyer that wanted to do a seller finance contract, who wanted to own it. So this was a lease option. We were collecting rent. We collected a $2,000 down payment option fee, and the borrower was contributing on a monthly basis for a year to build a little more capital into the account, to his account, to then convert to a seller finance loan. So we had a buyer in the property for well over a year. Like I said, it was tenanted I bought it from another investor. We were getting a steady $600 a month income. The property is a 1940s concrete block structure, Pensacola, Florida. It's 1,221 square feet, although sure doesn't feel that big. It's a tiny little starter home, 3-bed, 1-bath. And it had some rehab done previously, and it needed a little more, and we did a little more. So it was all good. We were in it for $30,000. We were collecting gross $600 a month, and as we say, what could go wrong? But I wouldn't do these unless I talked about things that went wrong. We've talked about this property before. I like to talk about it because it's easy numbers to understand. So the next step I should take you to is let's see. The next step I should take you to is to an Excel sheet, which will show an internal rate of return, so you have an idea of how the project turned out. No, before I do that, I'm going to, go.
What's the story behind why you decided not to flip it and why you decided to hold it and rent it?
Oh, okay. So it's thanks, because I was starting to backtrack on it. No, I'm going to the end. So
it's not the end.
Yeah. So it's not the end yet. So it was a starter for our foray into seller financing. It was also our starter into buy and hold in Pensacola. It was a fair entry point. It was $31,000 in, so it was a small bet to start to learn what to do. If we thought it might have been the start of us building a pool of these, and I'm still not done with that idea, but we've been distracted, as you know, as well as those of you who've been on these before know that Nick and I have been distracted by 2,400 subprime unsecured loans we've written in the last year and a half. So we've had our hands full for a little bit. So here we are. We bought this property, and the intent was to hang on to it and collect payments, and then put it on a seller finance contract and collect those payments, and that was just going to be just wonderful. And in fact, we did that. We sold the home to the couple that had been in it by this point 2 years for $55,000. They had their $2,000 down payment, and we created a 10% interest mortgage note for 15 years, and was at $650 a month, PITI, and we were good to go. And like I said, a couple of years ago, I discovered this thing called partials, and so here was a really good exercise on a loan that I thought would be a rock solid partial. So we after going to seminars and reading materials, we put together a note. We put together this note, and then we put together a partial, and I sold 84 of the payments to an investor in Chicago for exactly my entry point, for $31,000. So the magic was 84 payments went away. There were still 92 payments, I think, that were going to be ours on the back end. I had all of our principal back, and we did it. Let's go buy another house. Again, the borrower was in residence 60 days. I've been on the property twice over the 2 years. Good family man. Everything's wonderful. Lower income, blue collar folks. And then suddenly, as soon as I had sold it, the payment stopped. The borrower had an immediate family tragedy, and picked up his truck, got in his truck, drove to Alabama to take care of his mother. His father passed suddenly, and the borrower abandoned the house. The wife and the kids went somewhere to family. He went somewhere else to family, and we didn't hear anything for 30 days. When I sold the loan, I had in the partial, I had included buyback language in the event of default. I didn't want to wait for an entire default process, any of that. I bought it back. We bought it back and refunded it immediately. I didn't want to saddle anybody with cleaning up. I never want to saddle anybody with cleaning up my mess. I skip traced the borrower. I found the wife. I come out of the collection world, so I know how to do that. Talked to her. She got hold of the husband. They came back into a title company office, and in a cash for keys exchange for $400, $200 each for their gas and time and trouble, they deeded the house back to us, and there we were. My man on the ground, who is the reason that I'm doing work in Pensacola, is my brother-in-law, had a tenant waiting in the wings for it. But we took possession. We walked into the house, and we were just aghast at the conditions that the family was living in. It was sad. So $9,000 later, we put the house back together. We being my brother-in-law, not me, put the house back together, which is a lot of money for a house that little in a neighborhood that sketchy, and it's fine. It's fine. So like I said, he had a tenant waiting in the wings. Took a couple months to get that done. I moved her in. She came in with no deposit because there was prior relationship between my brother-in-law and her. So rather than pay a deposit, she actually put in some sweat equity, and her family painted the interior of the house. So that was that was a little nuance there. So we trying to start off on the right foot. So that's where we wind up. So we put her in. That was, well, we'll see when we go to the thread. I think it was April of last year. Oh no, it was July of last year, because she's just came up on a renewal, and we've done a new renewal. She's expressed some interest in, again, having a seller finance agreement. I've had an offer to sell the property to another local investor, and that spurred us now trying to figure out, well, did we make any money? We've been busy doing other things, and we haven't really paid attention to this because it's kind of on autopilot. I'm going to share an Excel sheet now. At any point, by the way, anybody wants to jump in, type something in the chat box. Slow me down if I'm going too fast, or if you're bored. So let me share the Excel sheet. So Nick was kind enough to throw this together for me this afternoon. This is the financial history of this account. I find, I take a moment and maybe proselytize or advertise a little bit. I find all the stuff not all the stuff, lots of stuff I see out there that's offered to note buyers or flippers or stuff is high level surface kinds of things, and you don't actually really see a deal from the P&L. So, as I said, so we boarded this loan, and so we try to provide something you don't get someplace else. So we boarded this loan in January 2017. So that's more than 2.5 years ago now. We paid $30,000 for it. But the reason that we did is that there was a tenant in place paying $650 a month from day one. So we come in. We have no property management fee on this property. My brother-in-law, I get to take advantage of him, and he helps with rent collection when it's needed, and pokes by once in a while to make sure the property's still there. In the end of the year, we had a tax bill and an insurance bill. And so there it is. I have the house insured for the minimum. We're not providing any renter insurance. I've heard a lot that you should. But so here we are. We got this nice steady stream of payments, and which stops right here. This was in March, the last payment. Like I said. So that was so April rent was paid, or April mortgage was paid. Then we come to collect the May mortgage, and we can't find the guy. So May and June, the property's dark, and then we get it re-tenanted in September. I'm sorry, in July. Again, the cleanup was. The cleanup was $7,300 plus another subsequent bill that came in a little later for $1,400. I think it's a bit of HVAC kind of thing. I forget what that was. Maybe it was a window. But again, we've been steady Eddie collecting rent month after month. We're very happy with this tenant. She's great. She's great. And we're helping somebody, hopefully toward a road to home ownership, but she hasn't at this point been able to come up with anything like a down payment yet. So, did I cover that, or is there something else we need? And did I do that right? So now we're down to a question of selling. So before I go to the bottom of the screen, I thought I'd go and take an inquiry as to what the market might be, and I went
And
off to Roofstock.
you sold the property to the tenant originally for how
Yeah,
much, Steve?
$55,000.
Fell out because
Yeah,
you had an actual appraisal on the property
yeah,
done.
yeah. I got a real appraisal, and it came in at 51 or 53, something like that.
Mhm.
So it wasn't. We weren't being egregious and loading up on the loading up on the borrower. We're being fair. Let's see. What did I have? What did I do with it? Oh, here it is. All right. Oh, nope, that was that. Hold, please. What am I looking for? I'm looking for my Roofstock offer. Oh, that's in my.
So for us in California, it's $650 a month, even if it's net $550 with your $55,000 ARV. Um,
Yeah.
that's
Oh, yeah, yeah, yeah.
better
And if you net $500 on a rental in California, you've got to spend $250,000. Right. So there's money in cheap homes, but as we just disclosed, there's stuff, right? Things happen. You can't do it, I think, unless you've I wouldn't do it again unless I had make sure I had the right people, and he's listening on this call. But here's
he,
so yeah. So yeah, so he's being anonymous. He's hanging out in the background. So
he just told me he has an offer for 25.
yeah, yeah, yeah. So I plugged it into
Sorry.
Roofstock. I plugged it into Roofstock. Um, I've got a friend, another one of our little tribe that works over there. The guy who owns, I don't know, a dozen properties in Greenville, South Carolina, and I plugged it into their system to see what they would say. And so here we are, 1,227 square feet, built 43, small lot, 3 bed, 1 bath. Crummy neighborhood, 2 stars, 1 star on grade school, 3 on high school and junior high and college, high school. They come back. Their estimate is to price it between $45,000 and $50,000. They're off on the rental considerably. This is not an $800 square foot neighborhood. But so that was
That's consistent with your appraisal.
yeah, consistent with my appraisal. And I've got a comp I have a similar comp 1944 at 51, and I've got a 46, and I got a 45, and I got a 45, and but again, I don't know the difference between one of these addresses or another without driving it. But this was cursory. Let's take a look and see what would happen. Roofstock is a pretty robust marketplace for this. They've got a call center staffed by experienced real estate folks over in Oakland. I think there's 100 people in the room all total. They're formidable, and they're backed with I think it's Google money that's running that, and they're really trying to make a difference in how houses trade and make real estate agents irrelevant. I take this 45,000 number because it's just there, and I'll go back to the spreadsheet, and we're going to plug that in down here at the bottom, and we can see all that. So in this exercise, with the expenses and the collection of all the rents and all the stuff that we do, if we exited at $45,000, we'd have a net return of 22,228 if we sold it today. We have another rent payment right around the corner, probably already in. And according to Excel, we've got an internal rate of return to date of 26%, and a gross ROI in 2.5 years. So that's 2.5 years, 70. That's 20, about the same, about 26% annualized return, right? And so it seems to have turned out to be a whiz bang home run, at those kind of returns. Downside for me is is velocity of capital. Without the on the ground support, it very likely could have sat dormant for a long time. Could have been put a worse tenant in and had it destroyed instead of just beaten up. So there's lots of things that could have gone wrong. It's in Pensacola. It could have had a hurricane. But it's so it's turned out to be okay, and so that's the thought about what do we do if we exit. Nick, you worked up what do we do if we hung on to it. Let me open that.
Play the other side of the argument is what if we were able to hang on to it, increase rents over time, do the long-term play, and then continue to hold on to it or sell. So,
so
rent it out for 7 years and assumed a $50 a month or a $50 a year rent increase. That was being discussed in the new lease negotiation. Was going up to $650 to $700.
So do I have the right one open? Can you see it with the IRR at year 7? Okay. Or do I have the wrong window open?
I just see the email. I don't see the Excel sheet.
Okay. All right. Well, I've got to switch Excel sheets then. All right. Hang on. Oh, please.
So what's interesting is the 26% annualized return on, I don't have the PDF nor share my screen, but the original pro forma had an annualized return of 28% on the flip.
Mm-hmm.
So.
Yeah, so we were really close to what we thought. We thought it was a hypothetical $18,000 net. So I opened that back up. Let's see if I can get the spreadsheet open. New share. Whoops. Let me stop share. Let me stop share and share again. All right, I have it right now.
Yeah.
Okay. Right. And so you went down here and you added between line 35 and 119. You added you ran it out for the rest of the period.
So rents would go up to $1,000 over the next 7 years, and there'd be some improvements in the property by then. But you assume the same increase of taxes and insurance. So just hypothetical ballpark.
Mm-hmm.
We don't have to. Tenant continues to pay, or it's re-tenanted. Maybe you can get the same benefit of someone putting in some sweat equity and doing some repairs, and the rental income you'd bring in over the 7 plus 2.5, so effectively about 9.5 years, total of about $90,000.
Right. And so this is
3 times your original purchase price.
Yeah. So this speaks to the discussion, in the vernacular of, do we want to, do we want to get wealthy, or do we want to, have money today? And so this certainly solidifies the idea of either through a seller finance another loan, or basically just holding it as a rental. I think you'd have to go in and chip some of these, add some more costs in there because it's not going to be property managed forever for free. You'd also have to consider some significant repairs over time. But even if even if you cost another $30,000, the whole, you had to pay another $30,000 over the next 6 years, you're still going to be double your money, right?
Yeah. So actually going to sell B118, Steve, and that $75,000 is a ballpark number I pulled out of the sky, not even out of the ballpark. But what I want you guys to see is if you put that down to zero, your IRR only goes down from 25 to 17%, which people today would say 17, 25, that's still a good return. So even if your disposable value, you depreciate it down to zero and you give the house away to the tenant, the
Okay. So I changed it to zero, and you can.
So the formula updated. So your ROI goes down significantly, but your IRR, because the money's coming in so much later, really only goes from 25 to 17.
Mm-hmm. Yeah. So making it then that would make the case for if this turned into an amortized note for 7 years and came to zero, it would. So if you put it if you put it on a new note for 15 years, I'm going to have $30,000 left halfway through. And there you go. If I put it on a seller finance loan note right now, I save the expenses of taxes and insurance, and so maybe that works better. Maybe the payments, and you can play with it. Maybe the payment's too high. Maybe the payment should be $550. And even if you went with $550, can I do that? If I don't know how to.
You unhide the cells.
All right. So let's just say I'm scared about the state of the economy, and I just want out. And I went down to $550 to move it.
It's a pretty good deal.
And so this is I make a super deal for the tenant, the new tenant buyer, and come down to, and at this point I've got this note. I have a remaining $30,000 still. So, and even if you cut that to 20, I'm still doing well at 13.6. I'm not very excited, so I want to go back to my 30. So
to pay about the same payment net after build in a little bit of reserve for repairs and such, and then essentially it's kind of like an option for them to purchase it at a set value. So here's all the rental payments, just the way to look at it, and then $30,000 option to purchase it at that price in 7 years from now.
Mm-hmm.
That's a killer deal for the current tenant.
Yeah. She's earned half of a house.
Encourage them to take that deal as a their own financial best interest.
Yeah, and with a little bit of appreciation and inflation, that $50,000 house that we started with is certainly going to be worth 60, right? So she picks up that, and she's paid halfway down, and so she's put $20,000 or $30,000 in the bank for somebody who doesn't have $100 in the bank today. And this was the mission that I was starting on 2.5 years ago, was to try to do good by doing, do well by doing good, by providing, by providing habitat. There's a lot of work that goes into this. There's an awful lot of on the ground work that goes in, and making making this work, and and having something to share was what we were targeting for. But fixing old houses, man, that's that's not for the young, or maybe it is for the young. It's not for the faint of heart. So this was the exercise that I wanted to go through today. I really wanted to take numbers and put them out and play with them, and show you what could happen. We have a $650 rent payer today. If I sold her the house tomorrow, with her payment being $100 less, so she had money to handle her own taxes and insurance, would be, we'd be okay. But if I go back to what Nick was thinking, that we're 650, what are we really walking away from? We're walking away from, let's go down and get that bottom number. Here's your gross cash, right? 65 plus 30, so 95 is gross total collected. If I go up here and say we're gonna, and I'm gonna, let's give her a rent increase here at 700. So say in a year from now, she'll have been flat for 2 years, and then a raise, and then a raise after 2 years. And say we kept the place, and we'll call it worth 50,000. So we were at 95 before as what our gross total yield was. By keeping it as a rental, you go to 98. You go to 98. It's real. Am I doing something wrong? It doesn't seem to be, that much money different, except you have a whole house that you're still renting. You still have the asset. So yeah, so you're giving up $20,000 in equity, and the lack of continued the joys of continued ownership of entry level housing. But it's seems like we should have done 10 of these, right? Instead we did 4. We had 4 and 5 other projects there over the last 2.5 years.
Steve, what do you think about that neighborhood in Pensacola, Florida, in 5, 10, or 15 years from now? Because we like that market for several reasons: affordability, stability of employment. There's the base there, as well as maybe Federal Credit Union and
an annual migration of Northerners and retired military to Florida, Atlanta, Alabama, all along the Gulf. Florida in general is net increasing significantly. Pensacola continues to grow. If I was, I'm thinking about, if I wasn't so yield hungry as I seem to be these days, still haven't gotten over that affliction, I would step up in product type, and we have one. The house on 77th is a $170,000 house renting for $1,300. So it's not, so the multiple isn't as good. I think you could probably, I'd step up a little bit. I'd step maybe into $100,000 housing, maybe 120, and be happy with these numbers being 10. right? But the benefits are a more stable asset, a better structure, a newer structure, and in a neighborhood with less issues. And but it's again, your returns, your annualized returns aren't going to fit the cash flow desires that we have, but it fits the wealth button, right? What would if you had Nick, you're 31, if you had just instead of it being a $50,000 exit, if it was $100,000 exit, and your rent was 900 instead of 700, you could live with that. You can't come close to doing that in California. And I still like Pensacola. I still like the town. I think it's got it's a tertiary, certainly it's a tertiary market, but it's got an economy. It does. It's got a middle class, and that's who I'd be looking to serve middle class seniors. I think that's what I'd be doing. I like Gulf Breeze, but that puts you in the $200,000 price range, I think. But the $200,000 price range is the house that we funded, and then the other subsequent lots. Yeah, with the $250,000 houses, nice brand new $250,000 houses are easy to sell and rent down there. So yeah. So now we haven't looked at this. I'm babbling because we haven't looked at this, and I haven't thought about this in a long time. Would I keep? Should I keep it? Should I sell it? Yeah. Nick, I think you're making a case here to keep it, right?
We would have sold it already if we needed to, right?
Yeah.
There's more important things to do. So sit back, collect your rent payments, and then 7 years go by, and then oh yeah, that house.
Yeah. On it, and it only shows up in my thought, once a month when Peng, our admin, says, did the rent payment get posted? And I say, yeah, it's in the bank. Okay, and she posts it. So,
and I think the keeping, we're always looking at, there's always an exit, right? There's always a value. So with the right tenant in place that wants to take the original deal that you had in place in 2017 that fell through in 2018, they could buy it and seller finance it, and hopefully the next time would be successful. But there's always a price, and so knowing your return threshold for anybody listening, we can afford to sit on this for a passive low 20s with a stable asset behind it. That's not bad.
Mm-hmm.
Would we, and that would be anything above that today, maybe over 30, we'd say yeah, absolutely.
Mm-hmm. So you're not inclined, one way or the other to hold it. So I'm thinking, I want to hang on to, to better property, better dirt, things that are larger. We don't pay attention to this because it's too small. We got bigger things in front of us. The adage that we repeat all the time is, we can have anything we want. We just can't have everything we want. And and that falls into this. Is it better? Is the property and the borrower better served in somebody else's hands? So, but I mean, we're busy. I just hung up a phone call with an engineer about getting soil samples to build a mobile home park, and that's 50 of these all in one place. So there's some that'll keep my attention better, right?
So I just plugged in 55,000 as a sale price today, going back to the original price, which would generate a 37% IRR.
Okay.
Time value money, if we wait 7 years and whether we sell it for 75,000 or 55,000, having all that cash outstanding for that long costs us money. So velocity of cash is important. So yeah, we sold it today for 55,000. You've got a 37% annualized return.
Right. So that you do. Yeah. So it's okay. All right. Well, I appreciate everybody sharing in as Nick and I kick this around, because we haven't frankly had any time to kick it around till late. I said we're all hot to trot on our unsecured portfolio and this mobile home initiative that we're working toward. So the floor is open for questions. We've been at this for 45 minutes. We try to hold these calls to an hour. Any feedback, any experience? Somebody want to type a comment? So do I have, I have chats open. Oh, okay, chats are open. Okay. How is the ROI calculated? Could you highlight the cell? So Nick, you did that. That's
down. If you scroll down, should be taking column G, the ending property basis. So
here it says XIRR.
He's asking about the ROI below it, 319%.
Oh, you want to be down here. Okay, how do they do the ROI? Okay, and so the ROI was G119 there, divided by minus G2 up at the very top, which was the our original purchase price. And so the XIRR function is to smooth uneven cash flows. It's an Excel function, and there it is. It's one of the equal, and so it's XIRR, the range F2 to F19, and then the range A2. So it's the cash flow range and against the date range, and it figures it does some magic and figures it out on its own. So Nitin wants to know what cities you're buying and what's the best places to look for these properties. Roofstock is, I think, Roofstock's a good place to get a market sense. There's tons of open places we all go poke around. I would certainly buy Pensacola. I made a mistake 3+ years ago, and I had sold a shopping center, and I took that money and I spread it out in 33 properties in 12 states, and that left me with no power over property managers or mortgage collectors. A lot of them were mortgages, and I would centralize to where my strengths are. My strengths are because of relationship in Pensacola, and of all places, Gary, Indiana. If you want to go play in rough and tumble neighborhood, Gary's the place. Just on the basis of it can't get any worse than it is now, at least you'd think. We're doing a project in Lake County, which is a depressed part of Northern California, but just an hour away from Napa, and it's a retirement community, and we're trying to build retirement housing up there to help the 1,000 people who lost their homes in fires over the last 5 years. So I see a note from Stuart. Yes, we're recording. The link will be up on YouTube tomorrow, and I'll email the group that when it's available.
Steve, how did you originally find this property? I don't know if you mentioned that. I believe it was a wholesaler, right?
Well, it was no, it was Eric. It was my brother-in-law, and we got talking about what he was doing and what I was doing, and we've since have done 4 houses like this and 4 lot financing deals for ground-up construction and 1 high-end spec home.
Lincoln was an MLS deal, so.
Yeah, no, none of the things that we've bought have been MLS. They've all been things that were sourced on our own. We're going to drop a mailing in our first attempt at dropping a blanket offer mailing on land in Pensacola coming up here in the next month to see if we can find some infill lots to develop. The having local team, so there's federal hardest hit funds that are still being spent for various reasons. The local counties get to choose how that money is spent. What Pensacola has chosen to do with a lot of their hardest hit funds is to use it for property renovation. There's been lots of damage to homes over the years from hurricanes and things like that. But they've put a program together where you can annually basically get half of major construction half of major repairs paid. So like you can get half of the roof paid, you can get half of your windows paid, half of your HVAC repairs paid. And you need somebody local that knows how to work those things in that community. And so it's that's the next step for this house is we'd invest $3,000 in a $6,000 roof. That would be the next thing that we do, because it improves the property and makes it more habitable, which therefore you can get back in rent over time. So
I think from what I've seen, being a part of the Bigger Pockets network, you find investors that have groups of these houses and sometimes don't look to just sell one, but they look to sell off their portfolio. And that's where you can really gain some economies of scale and put more money to work. And if you have a team in place in that area, it's more like Pensacola, that would be really attractive to us because we don't have to go buy these one-off. We can buy a bunch of them at one time.
Right. Yeah, which is how we've sold some of our notes. We sold them in groups. We had a pool of 20 and somebody bought 4 and that kind of thing. So it's there's lots of places with opportunity still in the heated real estate market that we're in. Cash flow is important, but I've got to keep chastising myself. Chasing 2% returns, monthly returns is I can't do that on everything. I think it's a recipe for disaster. We have a significant economic downturn. The 2 places that get hurt are the top and the bottom of the economy, and the bottom of the economy doesn't have the ability to rebound. You're going to see your $700 rent go to 0 and stay that way for a while, because there's rules in place that protect the renter from me, to keep me from just throwing them out in the street. And certainly that's not our goal. So, but anyway, anybody got any questions? Are we good? All right. Well, we're coming up on our hour. I said that was Nick Curry, and I'm Steve Hodgson, and this is Modern Asset Management's monthly go around. We took this note out this month. We took this property out that we've had out to show people before because it's now had some more things, and hope you heard us get you thinking about some things for yourself. And And you know where to find us. This will be up on YouTube under my name, under Steve Hodgson. And I appreciate we had 10 on the phone on the call tonight. I want to thank all of you for being here. And we'll see you again next month. All right.
Thank you.
All right. Anything else? All right. We're good. We're going to hang up. Okay. Bye all.